Tonight's agenda, like I say, we're talking about oscillators. This is part one of the oscillators. Okay, so tonight we'll talk about what are oscillators. We'll then discuss the theory behind oscillators. Then we'll move into a few examples of oscillators. We're going to focus on two tonight. Part two will cover a bit more. Then we'll do some market examples of oscillators on a live environment, so we can see on some of the charts of how they can and not always work, because nothing always works all the time. And of course, then we'll discuss the November schedule and of course question and answer session, which will be held at the end. So, what are oscillators? An oscillator, I tell you what, let me put myself on camera as well so you can see my ugly face. Hello. Hello, everyone. So, an oscillator is a type of technical analysis indicator which can potentially be used by a trader to identify if a trend might change and, we'll go over this a fair few times, find overbought or oversold areas. Wrong switch. Having lots of technical difficulties today. Oh, happy days. Forgive me. This potentially works when an asset is at extreme value in either an overbought or oversold zones. Now, the theory behind, and the most popular oscillators, is stochastic oscillators. Easy for me to say. Now, the theory behind these oscillators, it was developed by a man called George Lane in the 1950s. Now, as a side note, I might be sidetracking a bit, but I find this quite interesting because a lot of other theories or technical theories, these indicators are named after the people who developed them. Elliott Waves, John Bollinger for Bollinger Bands. But anyway, just on a side note, the theory behind stochastic oscillators was developed by a man called George Lane, and his name is not even mentioned, which I think is great. Now, oscillators calculates the closing price of an asset in conjunction of the high and low of the range over a period of time. In theory, the oscillator follows the momentum of the price of an asset before the actual price changes, which then can predict a sudden change in direction. What does that mean, James? Well, basically, it's calculating how fast the asset or price of an asset is going to try and then determine if, again, is entering the regions of being overbought or oversold. Now, the overbought versus the oversold theory. Now, George Lane, he was a big fan, or in his theory, he said that, stochastic oscillators really can identify when an asset is reaching even an oversold, overbought level. Why this is important? Because the theory is that if an asset reaches overbought levels, the asset might experience a sudden sell-off, and if the asset reaches oversold levels, the market might jump in and start to buy again. Now, we break this down into a little bit more than, obviously just a statement. That sort of does, in some ways, make a little bit of sense, because realistically, what moves the market is the number of people buying in of an asset and the number of people selling an asset. So if you've got so many people selling it, there's not enough people to sell it. So obviously the immediate reaction then is to start to buy up again. And if you've got a large group of investors, say, buying up an asset, and there's too many people buying the asset, there's no other people to sell it from or sell it to them. So there's no more sellers. So of course, obviously then those buyers are going to turn into sellers and start selling it off again. So this is obviously makes sense, because like the buyers and sellers, the amount of them who's buying, who's selling, does realistically drive the market more than most things. Now, there are many examples of different types of stochastic oscillators, and the stochastic oscillators are the most popular. And like I say, today's part one, we're only going to go over a couple. Now, here's some examples of some oscillators for you. And like I say, stochastics are the most popular, and these include the following. Relative strength index, which no doubt you probably heard, known as the RSI, that we will discuss. Pambaric SAR, which is another oscillator. Moving average convergence divergence. Rose off the tongue, that one, doesn't it? Or simply known as MACD. We'll discuss that as well today. Commodity channel index. Average directional index. Detrended price oscillator. So those are just a few of the oscillators. But like I say, for part one today, we're only going to focus on two. So let's start off with moving average convergence divergence, or simply known as MACD. Now, the theory behind this indicator is that it can help you identify when a direction of an asset may change to either a bullish or bearish direction. MACD settings is made up of three numbers. The number of periods for a faster MA. So there's two MAs. Those who want to know what moving averages are, I suggest you look back on my previous episodes, or one of my episodes in particular called How I Came to Understand Moving Averages. Okay. Now the number of periods for the faster moving average. The number of periods for a slower moving average, and the number of bars, which is the histogram, used to calculate the difference between the two. Don't worry, we'll go through some examples so it will make a little bit more sense. Now, unlike moving averages, okay, or simple moving average, for example, which is calculated by a closing price over a set period of time. The MACD does it slightly differently. The MA is calculated on the price, not calculated on the price, but on the difference between the two different MNAs, the faster and the slower. The histogram, or the bars, which we'll show you in a moment on an example, plots the difference between the fast and the slow. I mean, how wide apart are they? And clearly, obviously, the wider they get, or the wider the bars, or the wider the two MAs get, the bigger the bars are. And that's called divergence. And as they get closer together, the two MAs, the faster and the slower, the bars get smaller, and that's called convergence. Now here's an example on the Euro-Dollar 1 hour chart. Now, let me get my little pen so I can show you. Laser pen. Okay. So, the blue is the faster MNA, and the yellow is the slower MNA. These bars here, this is the histogram. So obviously, the closer they get together, the bars get really thin. The wider they are, the bars get bigger. Okay. Now, how MACD works, that obviously there's again the overbought and oversold territory. Around this period here, up here, it's suspected that the asset is overbought, so it could potentially sell off. The level down here technically indicates that the asset is oversold, so obviously the market can start to buy in again. The other thing behind this theory that is that, similar to the moving average crossover, okay, is that if the faster MNA, in this case the blue, crosses above the slower MNA, i.e. the yellow, and the bars narrow initially, then it could mean that the asset may start to rise. Alternatively, if it's in the overbought territory, okay, if the faster MA crosses below the slower MA, could indicate that the asset is oversold, so overbought, sorry, and the market might start to sell off again. Now, the bars, okay, you tend to see this, obviously the crossover, the bars get narrow because the difference is is closer. But as they widen apart, the bars get bigger, and obviously it means it goes to show the momentum potentially of that direction of that asset may continue. So let's look at some example here. So this is the euro dollar on 1 hour. So here we have the faster MA crossing above the slower MA in oversold territory, and the bars are narrow apart, again indicating that they're close and that we might be looking for a change. What does the euro dollar do? Does indeed move higher, so the market starts to buy in again. Go along a little bit there. We're now in overbought territory. The bars are wider, of course, at this point, showing that obviously the euro is continuing to move up. But as we're again in overbought territory here, and the bars get narrow, the faster MA crosses below the slower MA, indicating potentially the market is overbought and the euro dollar might start to sell off. What does the market do? Indeed, we see a bit of a sell-off. Okay. We then see it then crosses above it again. Very, very close though, so not strong, but indeed the market starts to move up a bit higher. But really what we're interested in, as we can see there, look, it starts to move higher. But then at this point, the faster MA crosses below the slower MA, still in overbought territory. And what happens here, of course, obviously then the euro dollar does indeed start to be sold off again. And we can see here it's oversold territory. Then again, like I say, we're below this level. Bars get narrow, the histogram gets narrow. The faster crosses above, the slower, and indeed the market starts to move up again. Let's look at another example. I wonder what that was then. Let's look at another example. Okay, this is the British pound, US dollar, again on a 30-minute chart. Okay, so we have our MACD convergence here. Remember, the blue is the faster and the yellow is the slower. So this is British pound, US dollar, 30-minute. Okay, the faster crosses above the slower in oversold territory. Indeed, the pound opens up with a gap, opens higher. Slightly approaching an oversold territory region, but the faster MA starts to move below the slow MA, and indeed the market starts to sell off. Again, not a real strong signal here. Sometimes people will say, but look, it's close, but yeah, you can argue it moves above it again and the market moves up, but yeah, not so clear in my mind's eye. But you can see here it starts below the slower MA, and indeed the market sells off, moves above it again, but this time it's not in the oversold territory. We should be down about here, but okay, it does indeed move above it, and indeed the market moves up, but again, it's not 100% a clear signal in my opinion, but the market moves up higher until, of course, we start getting to around about this region where it crosses below it, and the market starts to sell off again, showing that it's indeed in overbought territory. And finally, this little rise here, it starts to rise above it. Again, until oversold territory, but starts to rise above it, and indeed the British pound starts to rise again. Now let's look at another example. This is the dollar CAD, again on a 30-minute chart. Okay, so remember, blue, fast, yellow, slow, overbought territory, oversold territory. Let's have a look how this looks. Okay, faster crosses below the slower, and indeed the market starts to sell off. Crosses below the slower, faster below the slower again, and the market this time dramatically sells off. Really then comes into oversold territory, and when it does indeed, the faster crosses above the slower, does is you start to move above, and yes, indeed, the market moves higher. Here, again, all right, just come approaching overbought areas. It does cross below the faster does cross below the slower. There's a small sell-off there, so not a very strong signal, not as strong as this one here or as this one here is. So yeah, again, I say a lukewarm signal, but yes, it does do what it says, what it's supposed to do. Again, more of a lukewarm, crosses above it slightly, etc. there. This is gold on a daily. Now we're in oversold territory here, remember? But still, crosses below it, and the market starts to sell off again. Quite dramatically, stays in oversold territory. So realistically, but here, some people would jump in. So this is a false signal, but it's not strong enough because the bars are still close. The bars doesn't widen to show that they're separating. It stays closer. It doesn't really give us a strong signal that the trend is changing. So realistically, it's not really working. Then it does indeed finally breaks above it cleanly. As you can see now, the bars widen apart, really gives us more of a signal that yes, it's oversold, and yes, indeed, the direction may potentially change, and it does indeed. The market starts to buy in again, pushing gold prices higher. Here, lukewarm, realistically, because it's so close together, but as you can see, the market really is in a range, so not a clear signal there at all. And finally, it does go above it, leaving the oversold signal, oversold range, and as you can see, the bars then start to widen. It really then starts to push higher, and gold prices does indeed start to rise. The other oscillator we want to talk about is probably the most famous one, which is the relative strength index, the infamous relative strength index. Both oscillators, both these, what we're talking about, they're known as leading indicators, not lagging. So they're trying to base the price on what future actions could be, and the RSI is certainly known as a early warning indicator. Now, the theory is that if an asset is overbought, as we said, the market might still sell off. If it's oversold, then the market might start to buy in again. Now, the RSI has a value range between 0 to 100. So there's 100 at the bottom and 100 at the top. And theory is, if the indicator indicates that the value is above 70, the asset is potentially overbought, and that could cause a sell-off of the asset and causing the price to drop. And if the asset is at the value of 30 or below, potentially that asset is oversold, meaning the market might rush in, pushing the prices higher again. Theory, okay? So let's look at an example. This is the British pound US dollar, the cable, on a daily. Okay, so here is our RSI, all right? Yeah, so we got our 30 level around here, and we got our 70 level around the top here. So let's have a look. So at the moment, approaching the 70 level. Okay, approaching the 70 level here, indicating that maybe the pound is overbought against the dollar. What does the market do? Indeed, the market starts to sell off. Approaching. This is why I like to do these. I'm not going to say, these indicators work all the time, because it's not true. If it does, everybody would be multi-millionaires. But it's like I like to show the indicators when they do work and they don't work. Now here we go. If we look at this here, we're approaching the oversold levels. What does the asset do? It continues to fall. So again, not a clear indication. Eventually does start to react, and indeed, yes, look, the market starts to buy in again a small amount, but it doesn't approach the overbought levels. Instead, it continues to fall. So realistically, again, not getting a clear indication of the RSI, or RSI is really showing us that is at the oversold or overbought levels. It's really like I say, caught in the middle of the two. However, approaches the 30 level again, oversold levels. This time it's a clearer signal. And what does the market do? Indeed, the market jumps in and starts to buy the British pound against the US dollar, forcing the market up higher. Approaches the 70% level, overbought. Again, this is more of a clearer signal, because guess what? The market does indeed start to sell off again, forcing it down lower. Again, not really a clear signal here, not really approaching oversold levels, but still the pound then bounces up. Again, all right, approaching oversold. Yes, indeed, the market then does sell off. So again, that's a clearer signal. So like I say, that's a clear example that sometimes it gives us a clear indication what potentially could happen, but sometimes it's mixed and it doesn't take in the overall picture. Let's do the US dollar, Japanese yen. This is on a 30-minute chart. Okay, again, overbought, oversold levels. Oversold, pushing the 30 level. What does it do? Indeed, the market jumps in and buys in again. Then what happens there after that? Approaches the 70 level. Market then starts to sell off again. Yes, it does indeed react to that. Again, more of a ranging level here. No real clear indication. Certainly this isn't here. As you can see, it does start to move up. It doesn't ever approach the oversold levels. So again, it's missing us. It's not really giving us the right information at this point. And then, like I say, finally, this point, reaching the 70 level, does indeed reach the 70 level, meaning overbought, and the market does indeed sell off again. Okay. One more. Let's look at the WTI oil daily chart. We have our 70, our 30. Okay. So let's have a look. All right, approaching the oversold levels. What happens? Indeed, the market jumps in, buys in again, pushing the asset higher. Approaches the oversold levels around this point here. What happens then? Indeed, the market starts to sell off again. Approaching the oversold levels. What happens? The market jumps in, buys in again, pushing the, in this case, oil up higher. Again, coming up to overbought, but not too dramatically. So again, not giving us a clear picture. And the market and the asset does start to rise higher, so not a clear indication there. Till about this point when it reaches the 70 level, the dramatic level, and indeed the market sells off again. So like I say, like with all indicators, in my, like I say, I tend to find, again, you need to discover this for yourself because it's education purposes only. But like I say, some indicators, clearly give you a better, maybe a clearer signal. Others can give you mixed. And like with all indicators and all theories, it doesn't work all the time. Otherwise, we'll all be multimillionaires.